Hello, everybody. It is September 10th, 2025, and I normally take a 1 hour nap before these shows, and apparently I took about a 2 hour nap. Hence, I am very refreshed. So let's get rocking and rolling, and I want to start this month's macro and chart fest with something that one of the guys I follow put up, Mr. at Finance a Lot, and he has a chart up there. And for those of you who've been around a while, you should know that when the Dow Jones Transportation Average starts to lag, usually a bad thing. Now, there's a couple different ways to draw this chart, and one of them would show it more as a triangle than that curvy top that he likes to put on his charts, and it could signal that it's actually about to break out. So if macroeconomy land has the transportation index start to break out, which is a pretty strong signal that the economy is good, then maybe our correction that I said last time could be one of three scenarios, ends up being not only not a correction, but we get a melt up into the end of the year. It could happen. Liquidity is something that we will have to keep an eye on, and in October we will really cover liquidity because there is a number of events between now and a month from now that will give us some very, very strong signals on what liquidity is going to do. But according to this, the Dow Jones the Dow Jones Transportation Average might be ready to break down. And if it does, usually within about 3 months, the market follows. Now, interestingly, we've been chopping along the top of the market for a while, and that started, a little bit after this started to happen, this part right in here. But really, you can see it hasn't made a lot of headway for a long time. So while the general stock market has defied gravity, transportation hasn't confirmed except, some of the shorter term moves. So we'll see. Maybe transportation average follows the S&P 500 up at this point. Or maybe you start to see the S&P 500 start to come back in line with the transportation average. Hard to know. I've put out a ton of just posts in the chat rooms and over on XTwit talking about how the economy is flattening out. One of the things that I think is pretty interesting, and if you get a chance to follow it, I have been following Wisconsin Haven Realty. Find Wisconsin Haven Realty. There you go. This is my son and fiance, their firm. I've been providing some data for them. And one of them is what's going on in single-family housing. Now, if you live in Florida or Arizona or Nevada or parts of Texas, not DFW. DFW is really hanging in there, but Austin. Houston, how's Houston doing for single-family house market? Is it still pretty elevated, or is it starting to tighten up?
It's softening. We're down about 5 points year over year.
Okay. Yeah, a lot of the country is having a hard time. Now, the Midwest is doing the best in the whole country, which follows along with that thesis I've been giving you for 5+ years now, is that the best real estate in America is Great Lakes real estate. It's doing that well. So while a lot of other places out west in particular, and the Southwest and the Southeast are having a hard time, and even the Northeast isn't doing great, Midwest is pretty strong. So we are kind of having a regional slowdown everywhere except the Great Lakes region. And out west, it's pretty much darn right a recession in Arizona, Nevada, and parts of California. So single-family homes are really having a hard time. Why do I bring this up? Because it often leads the rest of the economy. Right now, 70% of all FHA loans have had a modification in the last 24 months. So either skipped a payment or had to redo their loan terms. Essentially, the extend and pretend that is in the commercial real estate market now applies to 2/3, a little over 2/3 of all loans that were done with FHA. That is, consistent with what time period, Shooter, Teresa? What time period did we see 70% of FHA loans having problems the last time? Pretty famous incident back in 2008. Yeah, the financial crisis. Last time this happened was the financial crisis. Julia Parker got it. So I don't know how bad this is going to turn out. But I mean, having 4 out of 5 regions really, really getting beat up is, I think, pretty concerning.
Yeah, I've looked. I can't find the data on how the immigration reduction numbers are affecting housing. There's no data there on that. But something else that we had too is that Social Security is rewriting the book, and there's going to be a haircut to part up like maybe up to as much as 270,000 recipients. I think that's going to wash and be a headwind for real estate as well. But I don't see the market as soft. I mean, I've had 3 houses on my street list, even though they were a little below market, all of them sold in 7 days.
And that leads to an interesting question. Now, for people who aren't aware, Shooter had another life as a mortgage guy. And I think that's probably the short story, right?
Yeah.
So single family housing impacts and construction broadly impacts over 10 million jobs a year in the United States. So if there's very little new construction for housing and commercial buildings, that's a lot of people who aren't working full time. So that's bad. And what have we always talked about? If unemployment shoots up, then a lot of those people end up cashing into the retirement plan. They don't all do a rollover and say, oh, I'm going to save this for the future. A lot of them cash it in and say, I got bills to pay. And I know a lot of people who, when they serve, when I should say I know a lot of people, I've seen and read and heard of a lot of people who, when they sever from their job and they have like $17,000 in the retirement plan, it's almost like they're like, oh, I have to cash this in now. I don't know what the mindset is. I don't know if it's ignorance or they just see the 17,000 and like, I'm cashing that in. But a lot of smaller retirement plans get cashed in. And of course, those are the first people that need benefits, after 6 months or a year. So especially after their unemployment checks run out. So between employment and housing, you have some big harbingers. I mean, these are the biggest harbingers out there after liquidity, which is kind of a precursor to these things. When we had the housing boom in 21 and 22 and really into 23, we had super cheap money, and the Fed's raising of interest rates and quantitative tightening really hadn't hit until really 2023. And especially in the last, I'd say, year and a half. I don't know if President Trump is right and Powell is too late and he should have lowered interest rates. What I actually believe is that it doesn't much matter, because the quantitative tightening, which I would have liked to have been done a year earlier, because I was talking about all this stuff happening before it happened, and lowering interest rates, right? I said interest rates should be a full point lower a year ago, a little over a year ago. Again, they don't call me. I did get an email returned by Austin Goolsby, so that was nice. He said that I could interview him for Seeking Alpha, which I'm going to set up and see if I can get it through everybody's legal departments. And I'm sure it's not going to be an open mic night. I'm sure they're going to say these are the 10 questions you can ask. But I am concerned that the one big bill, beautiful bill, the big skim bill, as I've been calling it, really blew out the deficit so much that even with $300 billion a year in tariff revenue, which, the studies are showing that that's coming about 70% on the back of consumers. So $200 billion more dollars in taxes to people who are spending all their money on goods and basically goods. I don't know. I am doing quite well because I'm an investor and I am able to use my debt strategically. Citigroup and JP Morgan just gave me 2 monster credit increases. I asked for a credit card so that I could fly on United to France, and I asked for a credit card so I could fly on Southwest to all the places in this country I go to, which, being in Milwaukee, I go to sunny places, which Southwest serves. And then I got another business card. So, suddenly, I've got credit coming out of my ears with a low utilization rate suddenly, and it's good for me, right? I got credit. I got a tax break in capital gains. I got another tax break for owning small businesses. It couldn't be better for a guy making 6 figures, right? So, and it's even better for people making 7 figures. If you're making 5 figures and you're trying to make ends meet, the tariffs have an impact. And I keep very close track at the grocery store mainly because Jolene does not like to go grocery shopping, and I do. So therefore, the economist does the grocery shopping. And I will ask the two of you, did you notice that eggs went back up $1 in the last couple of weeks?
Ours just went down.
Your
They were
eggs,
at 575. They went down to 375.
ours just jumped back up to 5.99 for organic.
Ours have jumped up too.
Yeah.
For the organic ones. Yeah.
Yeah. So the organic had dropped down to 4.99 for me, and now they're back up to 5.99. My theory on organic is this. I think I'm actually in line with RFK, which scares the shit out of me. But I think that anything that is whole foods are better for you. Pretty common knowledge, right? Cut out the processed. But I also think the things that you're going to not cook should be organic because it's going directly into your system. And eggs in particular, even though you cook them, unless I mean Shooter, when he does his Rocky thing, he chugs the raw eggs before he runs up the stairs, and but I cook eggs and I buy organic because I know that the chickens, if they're not organic, are so stuffed with antibiotics that is one of the main places that they pass through to us. That and milk, so there's a lot of things that go into our bodies and our children's bodies that, because of the nature of the animal, are just so jam packed with, if it's not the GMO, then it's the antibiotics. You got to wonder if there's something wrong with that for us. I do know that we have become resistant to a lot of antibiotics, and to me, that's bad. So I'm trying to keep my resistance to antibiotics low. If I take an antibiotic because I have an infection or something, I want it to work, right? I don't want to get MRSA and have them say, no, there's not an antibiotic we can give you. Say goodbye to everybody, right? So I buy organic for that reason. And I have noticed that organic prices have gone up. I wonder, because that's not really tariff induced, I wonder if that's because they know, hey, the people buying organic have a couple extra bucks, let's get it from them. So there's a lot of opportunism out there that I think that if you keep an eye out for it, you'll notice it. Just my 2 cents. All right. I'm not going to talk a ton more about the economy. I think that we are hitting a flat period on growth on the GDP side. I don't think that it really improves until we have pass through on lower interest rates. And if there's a macro event, which is, about as predictable as drones flying from Russia into Poland, I don't see anything falling off a cliff. I still don't. I just see a run-of-the-mill correction, unless, and what is the one thing that I'm afraid of? What would go up that would really scare the heck out of me? As you can see,
Fields.
Yes, as you see, class, I don't prepare the co-hosts ahead of time. I think if the long end of the curve goes up, right? If the long end of the curve goes up, then bad things happen. So Shooter, what happens if the long end of the curve goes up?
Great question. TLT is not responding as it should, and I'm not completely sure why. And, right now, even where we are with the implied rate cuts that we have right now, they're saying 50 basis points. We should have moved at least, 5%, 8% from where we are back to the upside, but we're not getting that. So, the honest answer is, I don't know how we're going to respond here, because the tells that I see in the market aren't telling me what is normal. They're skewed, they're distorted. So I don't know which way we're going to go.
Yeah. Well, if the long end of the curve goes up for whatever reason, then this probably, some version of this plays out, right? TLT falls.
Right.
And in the last week, the middle of the curve, 5s to 10s, have fallen a bit. That's what
Steady, actually.
Yeah. I own IEI, and so that's up a little bit for me. That's the 3 to 7 year bonds. 10-year has come down. How much does the 10-year come down? About half a point?
Pretty close to that.
Yeah. So those shorter term rates that I would rely on as a private equity guy that wants to build a building or finance a business, because the loans that we get are building loans, which are short term. And then 5-year notes, right? That's what business uses and what construction uses. But the long end of the curve, which is where mortgages fall, has been kind of sticky at the 20 and 30-year level. So what happens if it rises because international investors won't buy longer term bonds? That means mortgages won't come down, but building, because the short end comes down, will accelerate. So that's bad for home prices. Now, is that bad for society? No, I think that's probably good. I think that there's a lot of people who are locked into low interest rate loans and they're happy to stay where they are for a while. I think there's other people who are sophisticated who probably cashed out of their properties 3 years ago at much lower interest rates. I don't think you're going to see a lot of equity unlocked in people's properties, even though equity is very high right now. I don't know where that would come from unless mortgage rates come down, a couple points. And I'm not so sure mortgages come down. So I actually see a situation in real estate, and I bring this up because it's important to everybody. I see a situation in real estate where home prices and I talked about this too, and now there's official reports saying Kirk was right. Did you see the Zillow report and the Berkshire Hathaway report with the title Kirk was right again? The boomers just are starting to sell their big houses. And both Zillow and Berkshire Hathaway said for the next 10 years, boomers will be trickling houses into the market until it becomes a stampede near the end of the 10 years out. So I don't think home equity prices are going to do in the next 10 years what they did in the last 15. Right? In the last 15 years, home equity prices went up and up and up and up and up. I don't see that happening over the next time period. Historically, home prices increased inflation +1. So if inflation is 3% on average over the next decade, which I think is reasonable to project, then that would mean that houses appreciate at about 4%. If they don't keep up with inflation, which I think is entirely possible, given the dynamics of trying to stimulate construction, deporting 1 million people, and the long end of the curve staying pretty well anchored, I don't know that people who expect to make a ton of money on their houses will. So if you're a person who can sell a property for a real good profit, and for whatever reason, right, you don't want the property, you were just holding on to it for the investment purposes, you may want to explore selling it, and probably a lot sooner than later. In Wisconsin, you can make bank selling a property right now. But as we saw, will the Midwest stay this strong? I don't know. Typically we just follow everybody else eventually. But as I've said, the Great Lakes, we have enough winter. We don't really have a lot of winter anymore, but but probably half the winters we had when I was a kid. But we have enough winter to kill those big nasty bugs. So that's nice. The bugs have to start small every year. They don't just keep growing like alligators. And we have water. We have lots of water. So I think there's going to be firmness in Midwest compared to the rest of the country for an extended period of time. We probably don't get the hot streaks that the Southeast, Southwest, and West get, right? From time to time, there's years of big migration out there. We looked at a house in Celebration, Florida today online. And because I was like, maybe we should just get a place near Disney. We got 3 grandkids and I like Florida and there's always a casino around and I could, I love the warmer weather in the winter. So we found a place with flood zone rating X, which is less than a 1% chance of flooding. And, there's not a lot of those in Florida. You got to find one of the places that's 100 feet above sea level. And Celebration is one of them. But the housing prices, what you can get there compared to what you can get in Wisconsin, you literally get twice as much home in Wisconsin for the same amount of money. It was just, even with their prices coming down 10-ish%, $1 million down there bought half what it buys up. For $1 million here, you can be across the street from a lake on a half acre in a 3,000 square foot house. Down there, you don't get that. You might be near water, but you're not going to be in a big place that's newer. So
maybe a canal.
What was that?
Maybe a canal.
A lot of those, yeah, right. They talk about the canals in the ads.
Yeah.
So, it was interesting. Okay, so let's go back to Shooter's chart. So still not seeing a ton of upside in TLT. Someday it'll happen. Maybe it has to chop for longer, or maybe it finally, there's a spike in interest rates that holds for a year or so, and then it changes. All right, let's go down to let's take a look at the dollar.
The CPI question, I don't think I'm interested in bonds until the Fed really fully shifts gears and we get a clean direction.
But do you think the long end is terribly much impacted by the Fed? The long end is
Not
typically
at the moment.
Yeah,
I think the biggest impact to treasuries right now is going to be stable coins, because we really don't know how big that's going to get. And if it is true that Washington is trying to get rid of the national debt via cryptocurrency, that could get pretty big. That whole funding vehicle could get bigger than we could think.
Yeah. And as people should know, I am a non-believer that there's a chance in hell that can happen. So, I think that you can see by using stable coins as a way to extend American money markets into the third world, into the emerging markets, which is small right now. It's a small market to expand into. I talked about this on Stocks on Spaces and another program on X recently. The stable coins market in the developed world just cannibalizes existing money markets. The expansion would be to capture some of the money system in emerging markets that hasn't been captured yet. And there's some upside there, but I don't think it's monumental. And I think mostly it's cannibalization. It's not new market, right? It's not new market share. It's just eating something else that was out there. So I cannot find a legitimate economic analysis anywhere that shows how this somehow grows the pie, right? The only thing
it just shifts. It's just rotation.
Yeah, it's cannibalization. So the dollar, you're seeing that it might break this support and fall pretty substantially in the next
That's the count.
year.
That's the count. I don't have an alternative count on that until it gets back above that prior high.
So what would trigger the dollar falling off? Either severe weakness in the economy or money printing, or both?
Probably a collection of the both.
Yeah.
But you have to realize Trump is, he wants a lower dollar because it makes us supposedly more competitive
on exports. So let's dwell on that a little bit. I am a believer in the fourth industrial revolution. You guys have known that for years. And in a world where a robot here is as good as a robot there, I think that globalization was going to slow down necessarily no matter what, because something that you can build in Korea or Japan or the United States or China or India, because you are taking a lot of the labor out of manufacturing, and it's most manufacturing is going to be smart machines making other machines. I don't see where you can be a manufacturing export hub except on things where you have some sort of technological edge. Like, we have a lead in weaponry, we have a lead in certain tech, certain industrial machinery, but there's almost nothing that we make that somebody else can't reverse engineer and copy. I mean, they'll be violating patent laws, but as you have noticed over the last 50 years, China doesn't care about violating patent laws. I don't think India cares about violating patent laws, given the recent developments between Putin, Xi, and Modi. So I think everybody is in a world, and I think Trump is right about this. I think everybody is in a world where you better take care of yourself. The United States with Canada and Mexico, this trade block should be the best on the planet. And ultimately, I think that we pull Europe in pretty handily. It's just a matter of, at some point, somebody's got to be nice to somebody. And at the moment, they don't like being nice to each other. But eventually, I think it happens. So I don't see as much changing geopolitically as others think. I think that India continues to play both sides of the fence, or all sides of the fence, right? I mean, they're that lot in the middle of the block that has neighbors on three sides, and they talk to all of them, right? Everybody likes that Indian household in the middle. So I don't see as much changing as people think. I think that shipping is going to be flattish. I do know that the shipping fleet is old and that we need new ships, especially ships that are less polluting and less likely to sink or catch fire when something happens. But I think that globalization has roughly peaked. and it will drift down slowly over time. I don't think it's going to fall off a cliff. So the strength of the dollar, I think, eventually goes back up. Why? Because we're the best block. We're the best trade block, best economy. So even though if it goes down short term, I think we should expect a rebound because we're just not going to capture that many more exports because the machines are making everything and it doesn't matter where it gets made. So, it would have been nice to maintain the relationship with India. I don't know. Maybe India just didn't want to do what we asked, which was buy more oil from OPEC and less oil from Russia. That part of the equation confuses me. I don't know why India would say no to that, because OPEC's been saying for a year, we want to pump more oil. We just need somebody to buy it. Well, India was a natural buyer, and they said, no, we're getting it for $60 a barrel from Russia. So India picked cheap oil over the requests of the West and OPEC. So I would imagine that bites them in the ass at some point. But for right now, they're doing what they're doing. All right, so the dollar falls, and then I believe that it gets back up to all-time highs at some point, or not all-time highs, because if you take this chart back, it was much stronger at one point. But I think the dollar gets back up here a few years out. I don't think we're in a perpetual drift down on the dollar. And that is an optimistic view. That's me basically saying that American exceptionalism is real. All right, SPY guy. What do you think about this, Shooter? Is this a broadening pattern? And I'm going to show you some stuff. I know QQQ is showing one. Is there a broadening pattern on here? Is there something that scares you on here?
No, I think we get a very, you look at our prior deep retrace. See how deep that is?
Yeah.
I can't see the count. Then you look at the prior blips down. See how shallow those are?
Yeah.
Pop up. We need some shallow dips here. That mound that's building out now, we've got a third drive that's going to come into that, and then we get a back test, and then we get another 3 drives above that, is what my thinking is. But I think the entire thing is like a rolling mound off to the top. And I think we're going to see something very simpler because the MO hasn't changed. Dip buyers are still coming in. They're still grinding it higher. Nothing's changed. If you actually watch the ranges, even though they're tight ranges, right? They're consistent and repetitive. You can see where the algos are buying and selling, and they're rotating like a lunatic. So I think nothing's going to change. We need a catalyst. It's going to give us dips once in a while. So get prepared, know what you want to buy on the dips, and then, add positions at that point. That's probably the only strategy that's going to work, I think.
Teresa, what do you think about the S&P 500?
Teresa, you're muted.
Teresa, you're muted.
Oh, there we go. Sorry. I agree with Shooter. I think that it could certainly pull back. I think that it is trading at the top of its, I like to draw the trending channels. It is trading at the top of its trending channel. It's certainly not a place, in my opinion, to buy it, but I think it wants to pull back, and I think that would just be normal price movement. I just don't see it breaking down. I think it breaks down to like 50, if it breaks down like 5,400, which roughly is a little bit lower than Shooters, but I agree with that.
So you're both in line with my 5 to 15% correction unless something bad happens.
Yes.
All right, that's good enough for me. Good night. No, just kidding.
Hey, Kirk, related to the discussion on TLT and interest rates and things, there's a lot of discussion about gold. I've seen you posted a bit on X about gold. What are your thoughts there? You read Luke Grumman on the Forest Through the Trees. He's got his opinion. Lots of analysts calling for a lot higher gold. 5,000 gets banded around a lot. I've seen you post a little bit about the cost of production on gold. What are you thinking?
So right now, central banks in Asia and Russia have been buying gold for a while. Years, and they've been soaking up the available supply outside of the Western Hemisphere. At some point, I just think that their attempt to supplant the dollar using a gold-backed monetary approach fails the way that it failed decades ago. Ultimately, they're banking on their economies being better than ours, and there is a fundamental reason why that will never, ever be true. is they don't have the consumerism and the consumer infrastructure that we have, and that we are expanding into other markets. So from the standpoint of accumulated wealth and the willingness to spend it, I just don't see China in particular catching up to us anytime soon on a per capita basis. The sheer number of people in China, Russia, and India, with India being the swing player here, is enough to make them the second block of currency blocks surpassing the euro at some point. And I don't think it's going to be so much tied to gold as it's just going to be the aggregate number of people, because India is young. The reason why the United States really, basically when I was in college, really started to go after India as a diplomatic partner was because we realized young population, up and coming on technology, could be a big consumer-based economy. Certainly, it's already a more consumer-based economy than China. And, they were in a geopolitical spot between, the West and China. So it is not good if you're a war hawk for India not to be on our side. And economically, having them part of our trade bloc primarily was good for us. And they're basically saying we want to be part of everybody's trade bloc, which is good for them. But then their overlords end up not being us or them, right? They end up being in charge of their own ship. They drive their own bus. And I understand why Modi is doing what he's doing. However, I think he's playing with fire to trust Xi and Putin especially. So I think the safest thing for him to have done would have been to add some OPEC oil, and without cutting the amount of oil he got from Russia, or only lowering it a little bit, right? He could have found a better way to negotiate this rather than saying "fuck you, Trump," which now they're in a "fuck you, no fuck me, fuck you, no fuck me." That's the kind of attitude they have towards each other right now, and I think Modi's playing hardball, and I think he's good at it. And Trump's going to have to cut a deal at some point that gets India to buy some OPEC oil and some less Russia oil. And now that Poland showed that they're not unwilling to attack Russian assets, I think that the stock that I was looking at today that I had an order in and I mentioned in the chat room that we're not going to name, the company that is very important to NATO, we should be looking at more in coming days. So on the gold part of that, geopolitically, I don't think it's going to matter that much to the price of gold, because ultimately they don't want to buy it expensively either. So I think the price of gold probably has a pullback along with other risk assets whenever that pullback happens. But then as countries and especially the Federal Reserve, whenever the Federal Reserve gets loose monetarily, then that'll push the price of gold up. Now, historically, the price of gold has been 30 to 50% higher than the cost of production. When I first started talking about gold in 2018, the cost of production was about $1,100 an ounce. It's up to $1,700 an ounce. 50% more of that is what, $2,600. So the price of gold, legitimately, historically, $2,600 is about what it would be. The fact that it's what, $3,600 today, give or take, that is the product of those central banks buying gold in a hope to deplace the dollar and reduce its role as a currency globally. But ultimately, you need a global reserve asset, and there just isn't an alternative. Bitcoin's not an alternative. The euro's not an alternative. None of the Russian, Indian, Chinese currencies are an alternative. So I think it ends up coming down to who has the best economy, the best economic bloc over time. And I think this plays out technically and geopolitically over years and years. But I don't see, I don't think the chance of the dollar is collapsing and the dollar as reserve currency is going away. I don't see that generationally being true. Man. I just don't think it's likely to happen in this century. So, Bitcoin is a fantastic trading commodity for stealing money. and Silk Road proved it. And we'll see. I suspect that there's already been one gigantic heist of Bitcoin, like billions. I think it just happened a few weeks ago, and nobody wants to say it. There were some original blocks of Bitcoin that hadn't moved since 2011 that in the last month moved. We're talking billions of dollars worth. Hadn't done anything 15 years. And suddenly they all moved. They repositioned. That, to me, screams either theft or somebody big is cashing out. Either way, not good for Bitcoin. I think that Michael Saylor is terrible for Bitcoin because the whole point of Bitcoin was that everybody could have a little bit and it would be very valuable and it would be deflationary and you wouldn't have to worry about your purchasing power disappearing. But not enough people have bought Bitcoin for that to be the case where it would become a medium of exchange. It'll never be a medium of exchange except among criminals who are trying to get money out of different countries. That's originally what it was used for, to launder money out of China. So I just see the dollar getting strong again. I think gold will hit its top, which I think is going to be similar to the cost of production relationship that it's had in the past. And ultimately, the central banks, because these countries are not in, India is the exception, but China is not a growth juggernaut anymore, and Russia is not a growth juggernaut. So their ability, right, demand is willing and able. I don't think they're able to buy a ton more gold. So, I think that the big run in gold is 2/3 done. I do think it gets to around $5,000 an ounce on the next monetary easing, but then it might chop along for years and years, and it might even have a big correction back down to the historical price point of 50% above the cost of production, sometime in the next 5, 6, 7, 8, maybe 10 years. I hate the gold miners. The capex is just so freaking high. So the minute that demand for gold even flattens, they're in trouble. And their costs are going to go up. So I have learned that high capex companies that are not getting all kinds of government money typically flame out. So the only reason I'm in a company like a Metis is because they get all kinds of government money. I would never buy them if there wasn't all kinds of regulatory and tax stuff on their side. But they're going to be able to do similar things as Marathon Petroleum. Take a look at the Marathon Petroleum chart going back to when they reconstituted that company and spun it out of Marathon. That stocks up a lot. I'm not going to pull it up. It's at least tenfold, but something in my head says it's way more than that. So when you take a look at gold, I know that people want to pound the table and say, well, it's always been money. Bullshit. It hasn't been money in centuries. It hasn't. It hasn't been money in centuries. It has been a store of value because we think it's pretty. And when you turn it into jewelry or coins, it has a secondary value that people love and, the craftsmanship. And that's the gold that I buy. I have it in a 401k plan because I'm trying to protect people's retirement money. But I have said this for years and years and years. If you want to buy gold, yeah, you can trade GLD and you should, the two of you should be the ones leading that trade. But as far as just an asset to buy and hold forever, it's always made sense to me to go out and buy jewelry and invest in productive companies. Could you have done pretty good buying and holding gold as a financial asset for the last 25 years? The answer is yes, because the price of gold was about $300 an ounce when I first bought it. So it's 12x. It's basically done with the S&P 500. It's basically done what QQQ has done. So what I'm saying is I think that that's almost over with. I don't think gold will keep up with equities going forward. I say that medium to long term. Short term, I think it can keep up and even do better. So to me, you should be looking for a gold strategy that takes advantage of short-term strength, and you have to find that spot where it's time to sell. I don't know where that is. I think it's around 5,000 as an emotional thing, but it's already above its historical price point based on cost of production, and that is driven exclusively by Russia, China, and India, their central banks buying gold. That's what's driving the price higher. It has nothing to do with Americans buying gold. GLD, the fund, has not grown. So if the central banks of India, China, and Russia at some point, for economic reasons, which I'm sure will play out, at least in China and Russia, at some point, price of gold necessarily has to come down because they're going to lose major buyers. And anybody who doesn't think that Putin and the Russian mafia haven't been looting Russia of billions and billions of dollars for 20 years, you're out of your zucking mind. So as these old men finish with their looting and the next generation loses control of the countries, which they will, that's necessarily what will happen. Maybe the grandkids come back, but you understand how generational politics and business building and business ownership generally works. There's going to be a pullback. And I think sometime in the next decade, gold takes a major digger. How high it gets between now and then, that's your job. I think 5,000 an ounce is probable, but I don't see it being a to the moon asset. And correspondingly, Bitcoin, which we'll get to in a second, I think Bitcoin has that rally up to 300,000 that I've talked about for 3-4 years now. I don't see it getting to 1 million because I don't think it'll never become a medium of exchange, just like gold has never been a medium of exchange. The difference is that Bitcoin, in an anti-regulatory regime, and that's what we're in. We are in an anti-regulatory regime. Folks, if you want to steal right now, if you want to cheat on your taxes right now, if you want to launder money right now, you have never had a better chance to do it. That said, don't do it, right? Because if you do get caught, you're going to jail because you're not a rich dude who can buy their way out by giving Trump $1 million to get off the hook. So,
and he'll still bury you under the bus.
Yeah, or put you in prison. Put you in prison and you mysteriously die. So we'll see how that plays out. So you just got to understand that the game is different for us as 10%ers or whatever we are, give or take, versus what the game is for 1%ers. And that is true the world over. The rules for us and for them, the rules for 99% are different than for 1%. It's just the way it is. Should it be? I'm not arguing it should be. I'm just saying that's the way it is. And when I see giant piles of money moving and regulations changing, I understand that there are trades that I can make against that will profit me. And they don't care, right? Because I'm just part of the crowd pushing up their number. So that's what I think about gold. I do think Bitcoin has a huge rally because there's a religion around it now called maximalism. I think that I was actually going to write something about this, but I just got so much to do. Propaganda is more powerful today than it was during the 1930s. And it's because we have the same discontent that is more global, not just Germany, but we have global discontent that the internet amplifies 100 times over. Yeah. So I think that there's a lot of minds being bent, and that is dangerous. And that is why I think you always have to be a margin of safety defensive investor, because the minute you gamble, you better be darn good at it. Anybody know the saying from Puggy Pearson? Anybody know who Puggy Pearson is? Well, that's a no. Look at those. They got Migo. Do you know what Migo is? My eyes glaze over. So that was back in economics class. Puggy Pearson was the 1973 World Series of Poker champion. And he said there ain't nothing to gambling but knowing the 60-40 end of the proposition, managing your money. I'm getting the quote a little bit off, and knowing yourself. That's gambling. And I think most people are bad at knowing the 60-40 end of the proposition. People are constantly betting on the 40 instead of the 60. And I don't see that changing in investments. And I think that people's ability to even recognize things anymore as an investor or as a human being are damaged because we have allowed propaganda without limits, and we have allowed divide and conquer, and we have allowed a lot of things that actually have a residual impact on the economy and the investment markets, right? You guys study technical analysis. What is that? You're measuring emotions, right? That's emotions. So when the psychology gets so out of whack that we're shooting each other, is it a leap to think?
It's only a second standard deviation, by the way.
Yeah. So is it a leap to think that we're going to break something in the markets? I don't think so. And I don't think it's a leap to see extremes being more extreme. Even though at the moment, technically speaking, it looks normalish, but that spike up, that V shape that we just had, is actually not normal.
No.
So what next? All right, let's finish up with our investing thesis. Did I have Q? I did have QQQ up. Oh, so I wanted to show this is the Great Mattis. That's what he goes by on Twitter. And I talked about broadening formations, megaphone formations.
He loves them.
Yeah, so the NASDAQ 100 is in a broadening formation. JP Morgan, Shooter mentioned banks earlier, right? JP Morgan, NVIDIA, the German market. There are a lot of pretty big United Healthcare style corrections that can happen here. I'm not positive what triggers it, rather than just hugging that top line, which I think requires monetary stimulus, or a big uptick in GDP growth, and I don't know where that would come from. So, Shooter, what do you two of you think about these types of charts? Shooter, you said you're seeing a bunch of these out there.
Yeah, a lot of them. Yeah, the catalyst, it's not necessarily catalyst driven. It's when the smart money rotates to something else.
Okay.
See, right now, I was noticing, something caught my attention this week in my review was that the bank's ETF, they're using it, they're selling huge numbers of cash secured puts, lots of sweeps, lots of blocks. So for the short-term period of time, they're using that to earn some premium. So when that ends, then the banks as a whole will come off just like they've risen as a whole. And what it implies to me, what I think we're seeing, especially in the banks, is that we have a short-term period of reduced inflation, and then it reaccelerates. That's my opinion of what we're seeing there. And that's just digging down, deeper into what the charts are telling me. But the broadening formations, it's solely when the buyers disappear and they pull those orders. And, there's no buyers on that tape. That's what's going to cause, and you'll notice it's one by one. United Health was a great example. It really was oversold. I mean, really, the news that blew it up was a 1,500% reduction in prescriptions costs for U.S. citizens. However, they're actually a benefactor from lower prescriptions because they pay this prescription bills. So, that type of catalyst is where we see sometimes it's not logical, but it's going to be when that rug gets pulled, they're just going to retrace and they're going to go back to support wherever that might be. And that's just going to happen, with some names quickly, other names will be slowly.
Right. Teresa, I saw your articles with all the setups, and I appreciate that you did this. We're not going to go through we're not going to go through any of the stock charts. But, and Shooter, you have your article on borrowed time over at Fundamental Trends. I'm going to steal some of this for margin of safety. But Teresa, I want to know what you're really thinking about some of the patterns you're seeing out there. Are you concerned that in particular, NASDAQ stocks or banking stocks, whatever it is you've been looking at the most, where do you see potential weakness and it being a potential signal for more weakness?
I think that I think Shooter said, or maybe you said it earlier, it feels like it's rotation. So the SPY and NASDAQ are definitely trading at tops of trending channels and things like that. But within that, there's, you see all kinds of opportunities. I can't remember, there was one today, don't remember which one it was that we saw it can't remember. But I just think we're seeing a lot of rotation. Surprise, I guess maybe not a surprise. Renewables, TAN, that just sort of sneakily found a bottom, it seems, and is just slowly grinding up. We'll see if that's permanent or not, but I mean, it's looking good so far. So it just feels like rotation, but I think, Kirk, you've talked a lot about it. It's just rotating out of those stocks that aren't, out of those companies that aren't participating in this economy. So, that aren't using AI well, that don't have the tailwinds that we see in this new economy that's emerging. So it feels like it's more rotation. than a big, some kind of a big major correction to me. But there's things that are, there's definitely a lot of stocks, indices that are trading quite high right now.
Yeah. We're going to finish where we started. At the start, I told you that stock market capitalization to M2 money supply has hit a record. So right here, the blue line is the United States. This is the last time this happened. I guess it's right at a record, but it was 2000. So in order for this to break out higher, these companies have to become way more profitable and just justify higher stock prices. So given what's going on, I think that we're probably seeing last puffs on the cigar. Hong Kong is rebounding, but they've been high for a long time. And I think that's financial engineering. I think the United States is hype. Some of these other ones are higher than normal. So in a world where M2 is starting to flatten out, you need to see something happen. So if you go back, right, M2 is not high. It's normal-ish. It's off a bottom.
Almost at the mean.
Right, from the quantitative easing low. And this is as they've reduced quantitative easing and shortened the duration on bonds. Understand this point. As they shorten duration on outstanding debt, what happens? It comes due faster. So if they're reissuing debt at 2-year durations versus 10s, 20s, and 30s, then the debt that matured last year is already due again next year. That's what's happening over the next 5 years. Just tons of debt. And then in about 2030, we run into maximum boomer reliance on Social Security and Medicare. So the next 5 years, in a regime where price to M2 is at a record high after a huge rally, something has to give. I suspect that it's an order of things. I don't think it's one thing. I don't think just one thing happens. I think you get a big correction or two, that it's kind of split up. But ultimately, I think M2 to price has to normalize. And I think that you can just kind of see it. Let's go to 6 months, right? That last chart, it didn't look like M2 was leveling off, did it?
It has to expand.
Now does it look like M2 is leveling off?
Say that again?
The big chart, the expanded chart, it doesn't look like M2 is leveling off.
No.
But if you look at the last 6 months, suddenly it looks like M2 is leveling off, right? Because
that sample's pretty broad though too, because it comes in chunks.
Well, it's 6 months of money supply.
Yeah. So the next
this is the first time it went down.
Yeah. Next pop, it'll push it back above that. If
there's another pop, where does the pop come from? There is no new money creation. The one thing that could happen is next week, and it's not the Fed. What is the big thing that happens next week? If you own a business, tax bill. Okay. So the last time the repo market went nuts in 2019, and that's September 15th.
Good point.
Over the next 6 months, they used up the $1 trillion repo facility to support the repo market. And the economy was slowing down the exact same way that it is now as it was then.
I'm glad I bought October TQQQ puts.
So what is going on with the market and all the money supply right now is the same thing that happened in 2019. Now, will Jerome Powell put as much into the repo market and have that money flow through? And remember, it's not QE, it's a special facility, right? We make fun of that all the time. But there's $1 trillion that they can pump into the repo market. A little bit less. They've actually used a couple $100 billion this year already. So the $1 trillion facility, I think, is actually down to 700-ish billion available because they have been using it, which is why year to date money supply went up. So they put a little bit less into repo last couple months, and this started to come down. I suspect that they do put a little bit more into repo and this stays up. That means that through the end of the year, there might be one more puff, and into January with the January effect. There might be one more puff left on this cigar through January or the first couple of weeks of January. But if there's an event, it won't matter. And next week, you are going to see some volatility, at least for a hot minute, that the Fed has to fight by making sure the repo market doesn't fall apart. Because almost every year, this is a rough week. And we'll see what happens. But ultimately, I think we just have a softening in the economy that's not recessionary. And again, the caveat is if there's no event. I don't know. The list of possible events is really long. And then there's a list of things that we have no idea should be on the list. So your black swans. I think the biggest news today wasn't Charlie Kirk getting shot. I don't think it was anything in the Federal Reserve. I don't think anything was in the stock market. What do you guys think the biggest news today was?
The drone strike in Poland.
Absolutely. I agree with that. I think that, Russia disavowed it and said it was a mistake. What's the farmer's word we should use for that? Bullshit. I was trying to get Teresa to say bullshit. There's no way that wasn't the biggest event in the world today. And if there's more, I can see the Ukraine conflict really accelerating right now.
Yeah,
and that one company that NATO uses that we have a little bit of an investment in that I think I'm trying to expand right now because it's dipped, because they did a little dilution today. I think they're going to get some massive orders for their product. And we'll see if that's true. And I did mention it in the chat rooms that I was selling puts on it. So keep an eye out, because I think that the response by Europe over Poland is going to be the really accelerate the counterattacks through Ukraine, which means more weapons for Ukraine, which means more special advisors, which might mean, securing the airspace. We'll see. The French government collapsed. And one thing that you never do during a conflict is change your government. What if the French Air Force ends up enforcing a no-fly zone and NATO takes part? What if white helmets go in there? This is the closest we've been to having that expand. And honestly, I am not anti-Trump on this necessarily. I am anti-everybody that allowed Ukraine to have this slow motion invasion by Russia since 2014. I think George W. Bush is at fault because they were handling things on the treaties when Ukraine gave up the nuclear weapons. I think President Obama was soft on a lot of this, including the Green Movement in Iran that he could have helped. I believe that President Trump has been soft because he's tried to appease Putin. I believe that Joe Biden was asleep at the switch. He warned us and they didn't do nothing about it. And Trump is trying to make it magically go away. And he's realizing that Putin is telling him to go pound sand. And he's really mad about it. And he doesn't have nothing to do. Well, he does have something to do. If they enforce a no-fly zone over Ukraine, they're double dog daring Russia to try to violate it. And I don't know how that spins. So we'll see. Everybody wants to say that war events are positive for markets.
Historically, they have been.
Yeah, I mean, not if it destroys global trade, and disrupts the energy markets, right? I mean, a long war, you're building all kinds of stuff. A short war, that's disruptive and scary and volatile, which is why
we don't know what a technology war looks like either.
Yeah, and that's why I own. Volatility has collapsed over the last 2-3 months. To me, there's a volatility trade out there. Shooter in particular, I would love for you to find it. But to me, there's a volatility trade.
I agree.
I don't know exactly what it is.
I don't know that it's going to be better than shorting the equities. I think we've had such small pops in volatility. And again, that's distorted. And I'm going to say it's not tradable to the extent because they're using volatility to pump these markets. And I don't think any of us really understand that mechanism because they've not shared it with us. So it's sort of like a manipulated market for me. And that makes it challenging.
You have the traders who are largely millennials selling vol.
Yeah.
We did a sell vol trade back here. This trade right here, we caught that one. I told everybody right here it was going to happen. And then it happened. And we made, some people made 600%. And then it happened again at the end of the year and we called this one. I have missed most of these. I've kind of participated in some of them. I think there's another one coming. I don't know if it drifts down a little longer. But I think that volatility, if you were going to buy VXX for a week, right, and you can't own it long, because it's a day trading vehicle. I would say for next week, if you wanted to buy VXX on Friday, probably Friday morning, that might be a good time to buy it. Now, most of our investors, and most investors should be long only, right? You shouldn't be shorting, especially if it's a new thing to you. But those who are experienced at it, I do think there's a volatility trade in here for you. For other people, what is your hedge? Your hedge is to accumulate cash, sell cash secured puts so that you're only buying at lower prices and you're collecting premium in the meantime. And the one equity that I really like right now that is new is the defense stock that NATO has huge orders with. And then, by the way, AST Space Mobile pulled back. Remember I told you when it was 50 that I was selling a bunch of my AST Space Mobile and selling covered calls, and then I was going to try to finesse this and then get back in? Well, it's happening. So I've been selling $40 and $35 cash secured puts on AST Space Mobile and getting $4, $5, $6. $5.50 I got on the November 30, the December 35s. I got $5.50 today. So my net cost would be 30, which is in this area where I think there's pretty big support. We'll see if that ends up being smart or if this thing comes all the way down into the 20s. If for a hot minute I'm down on it, I can live with that. You know, I made huge profits from here to here. So I do think that if you haven't bought AST Space Mobile yet because you missed it and you just didn't want to chase, I think this is the correction you're looking for. I don't know if it bottoms at 35-ish or goes all the way down to 20-ish. I don't know. That's why you scale in with small purchases and selling cash secured puts at various strike points and durations. Okay, I'm not going to talk about any other stocks, so don't ask. And is there anything that you want to say, Shooter or Teresa, that you think is incredibly important to watch over the next few weeks, especially with the Fed coming up next week and the repo pressure from tax payments?
I'm just going to come off of a caveat of what was mentioned on gold. Gold inversely or historically has been inversely tied to real rates. So that means the 10-year TIPS yield is declining. That's a tailwind for gold. So I think we could run, my target was 3,600 on gold. I think it's a safe bet to go there. I think some other commodities like uranium are also safe bets right now, sort of a good place to camp. So I think that's the mindset that I want to have going into the FOMC and really for the rest of 25 is I want to be in safe places where I'm insulated to a great degree, where I'm limiting my risk or I've increased my margin of safety. I'll end with that.
Okay.
Yeah, for myself, since I watch the futures market and trade that a bit, I'll be looking for the short on any indices if it presents itself because we see it. I might go ahead and do that. But cash, obviously cash, and then primarily that's what I do. I go in, I jump in and buy that, sell the futures.
So is it fair to say that you're both looking for a little bit more margin of safety because things are stretched, and even though you think that there might be a little bit more upside, that you also see downside?
I think it's more that it's broken to some degree. We're not getting follow through to the upside. We're not getting follow through to the downside. So neither the bulls or the bears are in control. So unless you're a premium seller, the decay is working against you in every trade you put on. So that in turn, once you'll notice I've done some really unusual trades this last quarter for me. And that's because the traditional setups, the premium isn't following through well enough where they're profitable enough to maximize that risk reward. Like, you put on 10 trades, if 7 of them win and you have a 50% gain on average, right? That washes the losses that you may have. So when that doesn't occur on a greater number of setups that you take, you have to go off board. And that's one reason I've been using common shares and selling some covered calls on some names to just create some yield because I got some good yield on some names. And also I've been selling many more cash secured puts because it also gives me some insulation. I've done some of those into earnings versus taking the calls. because I didn't want to put on that risk. In Oracle, obviously in hindsight, I should have had at least a 3x position size on that one. It did work fantastic to the upside, but we stayed light. I'm not going to, ultimately, I'm trying to push that margin of safety down to a point where it's manageable, where I have a limited amount of risk on the table, is what I'm trying to say. And so I'm trying to stay less than 20% cash right at the moment.
Okay, I'm 60% cash, or higher in some accounts. But a lot of that cash is holding cash secured puts. So my unencumbered cash is only 20-ish%, maybe 30. Teresa?
Yeah, my cash is well, it's roughly about, I probably am holding a little more unencumbered cash. I'm probably around 30%. But I really do like using supply and demand. And so that means if the price of a stock, I sit there and draw those charts, and when stocks are trading in supply, which is where the sellers are hanging out, I don't buy. And I want to buy when price gets down in those buy zones, because that's where the buyers are waiting. And there's just a ton of charts out there where they don't favor either the buyers or the sellers. I think Shooter mentioned it, risk reward. I think I think two things for managing and creating that margin of safety. First of all, don't buy in the highs, don't sell in the lows. And then secondly, watch that risk reward. So if you can't make the risk reward work for you, then you're better off to not trade. You're better off to not buy. The risk reward just has to be there. And that's how I play that margin of safety. For me, it's the difference between, how much do I have to risk to get up to, if I'm buying, how much do I have to risk to get up to an opposing supply zone where I know that the sellers are hanging out on the time frame that I'm using. And if I can't get the risk reward that I'm looking for, I don't do it. Unless there's just a real fundamental reason to jump in, but I just don't do it.
Do you think it's indicative of institutional sellers that the market is starting to become choppy, that they were fully invested at the end of last quarter? So there's really not a lot of firepower from institutional investors. And the one thing that we have to keep in mind is that one of the biggest institutional investors are pensions, and they're in that curve of turning over from, they're starting to go into distribution, right? Because they're paying out the pensions and there's not new people putting in. So are your supply and demand numbers saying that there's a lack of buyers up here?
I think that, yes, I think that the altitude is getting really high. Yes, yep. I do believe that, because on so many charts, you can't see the sellers. You can't tell where they're at. I mean, the best you can do is do fib extensions to try to guess where they might sell, but you can't even find the sellers. They're not there. So
the buyers aren't there either.
And then the buyers aren't there because people aren't buying at that level. Sorry, I said that a little backwards, but you don't. Yeah.
Is this kind of this is for both of you, is this kind of a deer in the headlights situation where, you've already said that you can't tell who's in control. So do we have kind of a deer in the headlights going on right now?
I think the indexing is playing a big role in why we keep grinding higher.
Yeah.
I can't see that changing.
And Torsten Slok just talked about that again over at Apollo Global, right? So that's why I point to employment. If unemployment goes up,
when does unemployment spook you?
When it starts going up 0.2% month over month.
Me, 7%.
Well, that I'm more concerned with the trend. If it's going up 2 or 0.3% month over month over month, that's a horrible trend. And we may get, at once that's happened 3 months in a row, lots of people start to sell in anticipation of a recession. And I think that the early bears are already anticipating a recession. I'm in the maybe not camp. I just think it'll be a slowdown, 0-1% growth.
Sentinel thinks we got 2 to 3 years
before a recession.
Yeah.
Yeah, it's liquidity driven largely, and we'll see. I think big events start to happen with AI. down the road.
Well, we're already seeing it in jobs. I mean, we saw it in the black jobs report jumped to 7.5% unemployment. You know, look at the tech sector, it's up 15% year over year. You know,
Yeah.
so we already are having some very aggressive job losses.
Yeah,
And that's going to accelerate. I mean, we're going to have large blocks where something's developed that replaces that job and all of them are gone.
we still have over 6 million jobs available in this country that people just don't want to do or can't do.
Yeah.
So we're actually imbalanced. The number of unemployed people just surpassed the number of job openings, right? So JOLTS, I just showed that the other day.
Yeah.
If that trend continues with job openings and available workforce for that gap keeps opening, then we got big problems. I think we are within 2 months of knowing how bad that's going to get. And if there's an event that slows down the economy, particularly higher interest rates at the long end, then that's bad. Now, the long end of the curve.
Just a quick question, because you're more of a historian than I am.
Uh,
Back in 82 and 2009, we had spikes in unemployment, upwards of 14%. You recall that?
I do. My dad was one of them.
Okay. What is the likelihood, in your opinion, your micro macro kind of mind, that something like that could play out in the next 24 months, maybe related to AI?
Unlikely, because that was engineered by Volcker to crush inflation. So he sacrificed 10% of the workforce or whatever it was to crush inflation. I don't think that we have a giant inflation problem. I think we have an engineered inflation. I don't think it's organic. I think it's policy driven, because demographically speaking and technologically speaking and debt speaking, everything is deflationary or disinflationary organic. Yeah. But policy, counter cyclical policy, is inflationary. Yeah. So the politicians and the central banks have inflationary policy to offset the deflationary policy, because deflation is far worse than inflation. The problem is that housing has become a problem, right? Housing's become a problem. And that is a function of about 6% of single family homes, up from fractional 1%. Single family homes since the financial crisis are now institutionally owned or large investor owned. So you have 1 in 16 houses that's owned by an investor now. So that is millions of houses owned by institutions and investors. At the same time, we just had a population surge from immigration, and 10% of them are going to get deported. But, that still put pressure on apartment prices. So while the cost of buying a home is far ahead of, and I have that chart over at Wisconsin Haven Realty, the cost of owning a home has gone up more than rent. Rent hasn't come down. Rent's not cheap. Houses are just super expensive. And that's why I think that those alligator jaws, and I'll put this into an article, you can find it on my Twitter feed. I think the alligator jaws of housing prices between owning a home and renting, I think those come back together, but I don't think it's sudden. I think it takes several years. I think there's a lot of things playing out between now and the end of the decade that are going to make for a lot of sharp moves up and down in between periods of malaise. And I think that we're in a period of malaise. So we're going to have either one sharp move up and then a sharp move down when the malaise is over, or the other way around, a sharp move down and a sharp move up. We'll see. Now, the sharp move down is psychologically easier for us to deal with, because then we just know we buy cheap. The sharp move up, we fight. Oh, I don't really want to sell. It's going up. I don't want to sell.
Yes.
Right? So we'll see. But AI, if you think about all the people in tech who are losing their jobs, those same people will become consultants and go work for other companies, whether it's as individuals or part of a company, because they have to teach industry how to use AI effectively and machine learning effectively. Most of the people losing their tech jobs are going to find another job in a different role because they understand the tech, and now they're going to go and teach industry how to use it over the next 20 years. The middle management and the paper pusher jobs, those are going to 80% disappear, right? I have always managed my firm very lean. I fired everybody in 2015. Yeah, end of 2015. And I have done everything I've done is outsourced, right? You guys outsourced. So I think more of that is coming at the small business level, but I think the companies are going to be able to use AI as a tool for being more efficient. I'm easily 500%. I said this the other day to somebody. I said I'm 500% more efficient with AI. They're like, you're out of your mind. How can it be 500%? Because research that took me a week to do in the past or 2 weeks to do in the past, AI does in 9 minutes.
Yeah.
Now, I still have to read everything and double check it and find what I want to find. But all those PDFs, all those articles, all those citations that took me forever to search on Google and sort them out, the AI sorts it all out for me and summarizes it. I now have everything that would have taken me weeks to find on Google at my fingertips in 10 minutes. So, people who use AI to cheat on the answers on a test, they're not going to find work. People who use AI to become more efficient and actually learn and do things well, they're going to make a ton of money. But the person who cheats on writing their essay and they never really learn how to write an essay, they're zucked. They're in trouble. Now, remember, the U.S. economy is 70% services, and most of the job openings are service jobs that can't get filled. So maybe we become 80% services, and some of that is skilled trades. Some of it's waiters and waitresses. Some of that is nurses' aides. Some of it's nurses. So the jobs that can be taken aren't really that high, just not that high. So that's why you're not going to see a collapse in employment. Now, in the short term, in economic slowdown, unemployment goes 5, 6, 7%. That's still bad because people sell off their 401k, right? And they stop contributing week to week. But beyond that, I think AI just changes the nature of about 10% of work is going to change. 10% of work is going to disappear, give or take. And that 10% will be replaced by something else. But also remember, planet's getting older. Population's getting older. We don't need to replace them all. We certainly need a lot more healthcare workers, and we need a lot more mental health care workers, and we need some politicians with the courage to confront propaganda that the internet is unrelenting on, right? The messaging out there on the internet is so hyperbolic.
Yeah,
hyperbaric, a hyperbaric chamber, hyperbolic propaganda.
Hyperbolic.
Yeah. Yeah, and that's just the market. The reason I bring that up is because the stock market's like that. These sharp moves, like Open Door. Okay, somebody asked about this earlier. I wasn't going to talk about Open Door. We remember Open Door. We figured out pretty quick that it was a shit company run by shit people with a shit idea. And suddenly that stock is up 600% in a few weeks or whatever it is because a bunch of trading room chat buddies decided let's buy all kinds of calls and push this one to the moon. And they have a couple of cheerleaders who were in first. Yeah. Somebody says, oh yeah, Open Door just got a new CEO and the founders are rejoining the board. The founders sucked. The founders started all this bullshit. They crashed the stock. They're not going to help it. The whole strategy is bad. And in fact, you should be rooting against Open Door because they're bad for the economy.
What my tenure taught me in real estate, you be careful who you crawl in bed with because there's an awful lot of crooks out there in real estate.
Yeah. Oh my gosh. Look, hey, I'm a good Sicilian kid, and I'm going to tell you a secret. There's a lot of skimming that goes on out there, and it ain't all the bad guys. The good guys do a lot of skimming too, but they write the rules, so you don't think of them as bad guys because, hey, they're on the right side of the law, but they wrote the law. Yeah. I mean, if you don't think like that, you haven't watched The Godfather enough or The Sopranos or talked to some old Italians. Go to the Italian community center in your city and talk to these old men. Oh, they're funny. Just pump some wine into them. They're funny. So,
well, guys, I've got a date with a margarita before it gets too late.
Go have your margarita. Yes, us too. And I have to go comb my hair. All right. Thank you very much. Again, we go long every month on this one. This is our long form, probably longer than we intended it to be, but I think we covered a lot of great ground, and I will put this through the edit in the morning and get it posted. I am curious to see what the Fed says and does. I don't think the half point is in play, but if they do a half point, I actually think that the market will make the incorrect assumption that that's good. If they do a half point, it's because they're scared out of their wits. So we'll see. All right. Good night.
All right. Thanks, Kurt. Enjoy your margarita, Shooter.
You too.
Take care.
Bye-bye.